Hello everyone, this is Kevin Zhao, your finance professor at MTSU. Is there green in green? General Electric thinks so. Through its Eco-Magician program, the company planned to double research and development spending on green products. In fact, GE has already committed over $5 billion to its Eco-Imagination program and announced that it would invest another $10 billion from year 2011 to year 2015. With products such as hybrid railroad locomotives, GE's green initiatives seem to be paying off. Revenue from the company's green products was $18 billion in year 2011, with a target of $20 billion in year 2012. Further, revenues from Eco-Imagination products were growing twice as fast as company's other revenue. GE's internal commitment to reduce energy consumption through green treasury bonds saved more than $100 million, and by year 2010, the company had reduced water consumption by 30% relative to its year 2016 level. While GE was in part motivated by the desire to go green, from a financial perspective, the decision only makes sense if company makes some green. Given that GE plans to spend about $2 billion per year on such undertakings, it is obviously a major financial decision, and risks rewards must be carefully weighted. In this chapter, we will discuss basic tools in making such decisions. In this chapter, we are going to learn 5 very basic methods that professionals using in evaluating any long-term investment decisions. The first one is payback rule. Second one, accounting rate of return. Third one, internal rate of return. Fourth one, net present value. And the fifth one is profitability index. And among those different methods, the most popular rules that professionals are applying on a daily basis are net present value rule and the internal rate of return. And in this class, we will go through all 5 different methods, and we will learn the advantages and disadvantages of different methods. And here's a chapter outlines. Now, let's take a look at what is capital budgeting. Capital budgeting is the most important decision for any corporation. And a capital budgeting involves evaluating a long-term investment decision. Because it's a long-term decision which involves large expenditures. Normally it involves millions or even billions investments over the next 5-20 years. And the benefits that a company can get from those future investments can last more than a decade. Once the investment project has been initiated, it's very difficult to reverse. Therefore, capital budgeting is the most important decision for any corporation because it determines firm's future strategic direction. There are many different methods that the professionals can use to evaluate investment projects, and those methods are very different. In order to find the best methods to evaluate investment project, we need to consider the following aspects. First one, we need to ask first of all, are all cash flow considered? Second, is time value of money considered in that approach? Are those cash flow risk adjusted? Is there any ability to rank several different projects? And also we wanted to know if a specific method can indicate added value to the company. Now let's start with the most popular method for investment project evaluation, or so-called capital budgeting. It's called a net present value. And this method can tell exactly how much value is created in terms of today's US dollar from undertaking a potential investment project. The net present value method involves 3 steps. Step 1, managers need to estimate the expected future cash flows. In the second step, manager need to estimate the required rate of return for the project given its risk level. High risk project needed to come with higher required rate of return or the discount rate. And the last step is to find the present value of the cash flows that investment project can generate in the futures and subtract the initial investments to get net present value. Now let's take a look at some mathematical aspect of net present value. And from the first equation, you can see that net NPV or net present value equals sum or sigma sum of discounted cash flows. And here T refers to time periods of a project, and the T is from 0 to N. For example, if we need to take a 10-year investment project, then at a T0, company need to invest substantial amount of money. And in the future years, the project will generate cash flows for the company. So T is from 0 to 10. And in this equation, you will see 11 items. The first one is negative because it is investment outlay. And for the item from number 2 to number 11, those are positive terms because those are future cash inflows. And those cash flows need to be discounted at the discount rate. Why? Because time has the money has time value. $1 that can be generated from project 10 years from now should be much less than it should have less value than $1 that the project can generate 1 year from now. And the alternative methods actually look at the sum of present value of all cash inflows, then minus the cash flow investment at time 0. Although the forms are different, but essentially it's the same. Now let's take a look at how we can apply this NPV method for investment decision. And the simple rule here is if NPV is positive, then we should accept the project. A positive NPV means that the project is expected to add value to the firm, and it will increase the wealth of the shareholders. And NPV is a direct measure of how well this project will meet the goal of increasing shareholders' wealth. For example, if NPV equals $1 million, that means this project can generate $1 million value for shareholders in today's US dollar by considering all future cash flows and the cost of investments. And here's an example for us to calculate NPV. Let's say we have a 3-year project. At year 0, we needed to invest $165,000. And this project can generate cash flows for the company with different amounts. In the first year, it can generate $63,000, $122. In the second year, $70,800, and in the third year, $91,080. Although you may get other numbers such as net income or average book value, but those numbers are irrelevant when you are utilizing NPV method. Another critical number that you need to have is the required rate of return for this investment project, and we assume that required rate of return for this project is 12%, which is consistent with the risk of this project. And this required rate of return is the discount rate that we use to discount those cash flows. Now let's take a look at how we can utilize this NPV formula. NPV formula shows you that NPV equals sum of all discounted cash flows, including the initial investment expenditure. And in this case, the first cash flow is negative 165,000. And since it occurs in time 0, we don't need to discount it. And for the cash flow that occurs in the first, second, third year, we need to discount those cash flow respectively. For the first cash flow, we discount it once by using 12% as the discount rate. And for second cash flow, 70,800, we need to discount it twice. And for the last one, we discount it 3 times. Once you discount all those cash flows, you add those present value together, and you will get net present value, which is equal to $12,627.41 for this project. An NPV method can be easily solved by using Excel spreadsheet, and the table that you see here shows you the process of calculating NPV step by step in an Excel spreadsheet. Although there are automatic functions that you can utilize, but through this table you see every steps very clearly in calculating NPV. And once again, what we are doing here is simply discounting every cash flows involved in this project. For homework and exam, you might need to use your calculator to assist your calculation in NPV. Let me demonstrate how you can utilize calculator in calculating NPV. The first thing that you need to do is to initiate cash flow calculation function on your calculating by press CF. Remember, sometimes you need to do multiple cash flow projects in your calculator, and for this NPV operation, you need to clear the previous memory by press second clear work. So make sure all the data has been erased from your previous calculation. Otherwise, you may get wrong answers. And here we have 4 cash flows. So in order to let your calculator to calculate NPV, you need to let your calculator know what those cash flows are. Right? And once you do CF, second clear work, it will show, the screen will show C00. Essentially, your calculator is asking you to enter the first cash flow at time 0. And here, the cash flow is negative $165,000. Right? So on your calculator, you do 165,000 plus negative, so the number will carry a negative sign. Then you press enter. When you press enter, you will see arrows, up arrows and down arrows, and you press down arrows. Ask your calculator to proceed to the next step. And once you press the down arrow, your screen will show up C01. And here, calculator asks you to enter the cash flow for the first time period, or for the first year. And the number here is $63,120. And then you do enter and press the down arrow. And the calculator will show you F01. What is F01? F01 is the frequency of cash flow during time period of 1. Since there's only one cash flow occur in the first year, therefore the frequency is 1. And for most projects, or for most questions that you will come across in this class, the frequency of the cash flow is basically 1. So you just make all frequency of cash flow as 1. Right? And it's also the default setting. Once you see 1, you enter and press down arrow. Then we'll move to second cash flow, C02. Then you do the similar thing that you did for first cash flow. And here you enter 70,800 and enter down. Once again, we'll ask you the frequency. It is 1. Then you move to third cash flow, so on and so forth. Right? And after you enter frequency for the third cash flow, then it's time for you to calculate NPV. How? You simply press NPV. You're expecting calculator to show you NPV, but the calculator show you I equal. What does that mean? Well, your calculator needs to know more information before it can help you to get results. That is the discount rate that you're going to use to discount those cash flow. And here you enter 12. 12 means 12% discount rate. And you enter, press down arrow. And your calculator, once again, you're expecting your calculator to show you the answer, but calculator only show you NPV. You still need to press CPT to initiate the computation. Once you press CPT, your calculator will show you $12,627.41. That is NPV of this investment project. Right? I want you to repeat this process for at least 3 times. Right? So you will feel comfortable with the entire process, and your calculator, once again, is your friend. It can help you to deal with complicated financial problems. Right? And without the help of your calculator, well, you can still get a correct answer by doing this step-by-step calculation, but I highly recommend you to master both methods, right? Step-by-step methods and this automatic calculator method. Other than manual calculation, the calculation by using your calculator, you can also use your Excel, and Excel is a pretty powerful tool that you can utilize, although you cannot use it for your exam, but for your practice, feel free to use Excel. And sometimes Excel is much more convenient than your calculator, and of course your manual calculation. And here you can do step-by-step calculation on Excel, and also you can initiate the automatic function called NPV. Enter equal NPV, then it will show you then you need to enter the input of this function. The first input is the discount rate, and in this case it's D2. D2 equals 12%. Then it will ask you to enter those cash flows. And here cash flows are in cell B4 to B7, and you simply do B4 to B7 in this data input, and then the Excel will show you automatically NPV. And once again, the answer would be $12,627.41. Right. No matter you're using manual calculation or step-by-step calculation or one-step automatic calculation, those 2 numbers should be exactly the same. And here we use the 2 alternative methods. First one is discounting all cash flows with time starting at 0. And here we put initial investment expenditure into our calculation. And alternative method is simply calculate the present values of all cash inflows, then minus cash outflows at time 0. And those 2 methods are consistent with each other, and it will give you exactly the same answer. And the rationality for NPV method is the NPV show the investor exactly how much the value that can be added by undertaking a certain investment project. So the goal of the firm is to maximize shareholder wealth, and in order to serve shareholders' interest, company needs to add value, and NPV will show you the added value due to a certain investment project. And we should accept a project if NPV is greater than 0. And NPV is a pretty good method because It considers all cash flows, of course. It considers time value of money because we are doing discounting process, and the choice of discount rate should be consistent with risk level of the company, of the project. So it automatically adjusts for risk. And also it can use to rank mutually exclusive projects. Right? And if we have two projects, both generate positive NPVs, but we can only take one of them, then the rule of thumb here is to take the project that has the greatest NPV. And the NPV method is the most popular method used by corporations executives, and it's better than any other methods. Now let's take a look at second method for investment project evaluation, that is payback time period method. It simply answers the question, how long does the project take to recover the initial cost of project? Right? And the computation is very simple. We simply take a look at the estimated cash flow of the project. Then we subtract the future cash flow from the initial cost until initial investment is recovered. At that point, we will find the cut-off time or cut-off point, and that cut-off point is payback period. Right? If payback period is less than some preset limit, then we should accept the project. Let's take a look at one example, and here we use the same example that we use for NPV method. It costs $165,000 at time 0 and will generate various cash flow for the next 3 years. And here we simply look at cumulative cash flows. Right? And when you see cumulative cash flow turns from negative to positive, you see the payback period should be something between the second year and the third year. So the payback period equals year 2 plus the balance of cumulative cash flow at the end of second year divided by all the cash flow that can be generated in third year. And here you see payback period equals 2.34 years. What does that mean? That means this project takes 2.34 years to recover, to generate cash flow that can recover initial investments. Shall we accept or reject the project? Is this a good project? Well, you may say yes, you may say no. It depends on the preset limit. If company are expecting 2-year payback time period, then this is not a good project. But if company is expecting 3-year payback time period, then this is a good project to take. It depends on the preset limit on payback time period. Is payback time period a good method? Does it account for time value of money? Does it account for risk cash flows? Does it provide indication about increasing value? Well, when you take consideration of those issues, you would say, hey, payback time period method may not be a great method because, first of all, in the calculation, you don't see discounting, you don't see discount rate. Therefore, time value of the money has been ignored. And the second, the risk of cash flow is not considered because discount rate is not used in the entire calculation. It shows the years of, how many years it takes to recover initial investment, but it gives us no indication about how much that a company can get from added value from this project. Right? So there are a lot of disadvantages associated with payback time period, but it also has advantages because it's very easy to calculate and it's pretty intuitive. As a matter of fact, this method adjusts for uncertainty of later cash flows, and it biases towards liquidity, but you see a lot more disadvantages. It does not consider time value of money. Right? It requires a preset cutoff point and ignore the cash flow beyond the cutoff date and is biased against long-term projects. So as a rule of thumb, I would say for long-term projects, payback time period may not be a good project. At a certain time, manager may want to utilize NPV and use payback as alternative method to double check. Okay, we have third method to look at, that is average accounting return. This is a relatively new method used by corporate executives in project evaluation or capital budgeting decision. And the average accounting return equals average net income for a certain project divided by average book value. And once you get that AAR, or average accounting return, then you need to compare that number with the target rate. For example, your target rate is 20%, and based on your calculation, you see average accounting return is 25%. In that case, the project generates higher than what you expected. Therefore, we need to accept the project. But if AAR is less than the target rate, then we should decline the project. And here's the example in calculating AAR. And in calculating AAR, we do not consider cash flows. We only consider net income as well as average book value. And here, from year 1 to year 3, the project can generate net income of 13,620 in first year, 3,300 in second year, and 29,100 in the third year for its net income. And you take the average of net income for the 3 years. It comes with 15,340. Then you divide that number with average book value. That gives you 21.3% of AAR. Since the preset required average accounting returns 25%, and this project generates less than what you require, therefore we need to reject this project. Is AAR a good method to utilize? Well, we look at those critical criteria for a good rule to utilize in evaluating investment project. Does this method account for time value of money? Does this method account for riskiness of cash flows? Does this method provide indication of added value? Well, you will say, hey, this AAR method, although it's easy to calculate, but it does have a lot of disadvantages. Right? First of all, time value is ignored. Time value is ignored. When you get so-called rate of return, it's not a true rate of return. And it needs a preset benchmark cutoff rate in order to assist your investment decision. And the last one is based on accounting number, not a cash flow. Accounting number is net income, not the cash flow. And we know net income is an unstable number, a number that can be manipulated and is not as reliable than cash flows. Therefore, this method does have some serious shortcomings. Okay, before we introduce another very popular and important method, let's take a short break.